Matthias, just let me know if you're already on the call so I can make you co-host so that you're able to share your screen. Okay, as we get started with Matthias, I would like to ask a question to each of the people that are on this forum. What do you know about investing in government securities? If you've invested in government securities, what misconception did you have before that you've come to realize you wish you had known earlier? You can type in the chat or you can raise your hand. And I will have it mentioned. Thank you, team from Stanbic, who are coming along with Matthias, Martha, and Ignatius. I'm very, very delighted to be hosting you today. Anyone to respond to the question?
Hello?
Yes, please.
Yes,
please
good
go on.
evening.
Good evening to you.
How are you?
Fantastic.
Yeah. Why?
I've had a great day. We are going to have a great learning session. So why it not be fantastic?
I'm so sorry, my darling.
All right. I don't know whether I'm okay. I have some comments here. So this is Joe and Alejo say this is something I've always just heard about, but I'm interested. Susan says, not heard much, wanted to visit Bank of Uganda for inquiries. Today you're going to learn a great deal. And then Jayan David says, when do investors buy the bonds and securities? An interesting one, can be sure that it will be answered today. Treasury bills are bought from government agents, short-term, while bonds are long-term. That's an interesting one, Rose. Then Bright Ndhura says they are risk-free venture investments. Amanya says, I've never. I think he meant I'm here to learn about them. That is fantastic. All right. So even as we get started, I've come to realize over time that there are lots of misconceptions about what is needed or about what is required to invest in government securities. Many people fear that they need a lot of money to be able to invest in government securities. Many people are worried. Many people think they have to approach Bank of Uganda directly and they do not know where to start. As a result, they choose to say that they will leave that one out. However, it's not that hard. It shouldn't be the case. And as I let Matthias in, I would like to give an opportunity to Martha and Ignatius to introduce themselves as we get prepared for the session. Martha, Ignatius.
Thank you, Darius. Thank you so much. I'm Ignatius Chirunga, and I manage money markets for global markets. I'm on the call with Martha and Matthias, and I think they will take an opportunity to introduce themselves as well. But we are happy to be here and we'll be available to take you through the different investment options.
Thank you, Ignatius. You're very welcome. Yes, Martha.
Good afternoon, everyone. My name is Martha Brenda Nachavira. I work with Ignatius Chirunga and we work in the money market space. We are very delighted to be here And thank you very much for the opportunity.
Thank you once again for joining us. Can I confirm if Matthias is already on the call? All right.
I think Matthias has some challenges. We'll wait for him, but I think we can go ahead and start, not to waste so much time, and he can join us. Martha, can
right.
go ahead and yeah.
Hi, Darius and team. I'm now on. Good evening.
Yes, good evening, Matthias. You're very welcome. So you found when your team had already introduced itself. So we're saying we are very delighted to be hosting you and your team. The people on the call are very excited and eager to learn about investing in government securities. And I did assure them that you and your team are in position enough to share with them. Like I indicated to you earlier, we have a community of over 400 people who are interested in personal finance, and investing in government securities is one of those areas that they have always wanted to learn about. We've always shared about this, but we thought if we can have an extensive discussion, and if we can have someone who is who does this on behalf of Bank of Uganda directly, that they can approach, maybe that would also give them more insight. And those who want to take action can do so immediately. So right now, I would like to give the platform to you, and you'll handle it. Then we'll come back later for a Q&A. So right now, I'll give the platform to you, Ignatius and Martha, and then I'll come back later for the Q&A so that we can have an interactive discussion. If you're on the call, please, I would like to advise you that you remain on mute at all time. Let's not use the video feature unless you are a speaker because of the bandwidth effects. And also, let's make sure that we type our questions in the chat. For now, we'll be disabling the chat feature, the muting feature, so that we can give focus to our speakers. So Ignatius, the platform, Ignatius, Matthias, and Martha, the platform is yours. Over to you. Thank you. I'll stop sharing and allow you to share.
Thank you so much, Darius. And I want to also thank all the participants this evening for making it for the call, as well as ensuring that we still keep ourselves safe from the deadly pandemic. Darius, just confirm, I'm going to share just confirm this is the presentation that we'll be working with Martha, who are on the call, that you can see the
yes, Matthias, we can. Yes, Matthias.
Slides.
Yeah, sure, we can see the slides. Thank you.
All right, thanks for giving us the opportunity to discuss with the wider team regarding investments. And I'll lead part of the presentation. Martha, my colleague, and Ignatius will also come in. And they come with a strong being investment advisors as well. So we are in the right hands this evening. So I'll start and Darius request that probably you, Darius, you'll coordinate the feedback through the ask the team to share. Somebody talks about wealth. What is wealth to you? You can get about 3 responses, then we'll move on to the next level.
Thank you. Matthias, your network is a bit breaking. I don't know if you can try to remove your video and we see if it will help improve. But so the question is from Matthias that we have upon us is, what is wealth? You can raise your hand and I'll enable you to speak, or you can type your response in the chat and I'll pick it up. Okay, so the question before us is, what is wealth? Matthias, we have a response from Rose Akide, who says, wealth is valuable possessions or money. Wealth is money enough to cater for your lifestyle. That is Nicholas Rugaba. Those are the responses that we have in the chat. And then Joe Ruabose says, wealth is the period of time you can sustain your present lifestyle better. And then Robina says, when income is higher than expenses. And John Bosco Semuyaba says, wealth is the abundance of valuable possessions. And then Semerera Patrick says, wealth is an abundance of valuable possessions or money. Thank you, Matthias. Over to you. Those are some of the responses that we have.
Thank you, Darius. And thanks, Rose, Nick, Joe, and Robin and the others. You will realize that when somebody talks about wealth, what goes through one's mind is money most of the times.
Okay, so once again, my name is Martha. I'm going to share with you about the local investment options, which are known as the Treasury bills and bonds. So basically, there's a simple definition of what the Treasury bills and bonds relate to. These are risk-free, interest-bearing instruments issued by the government of Uganda. What that means is that the government, most times when it's looking to borrow money from the population, it doesn't come straight to the people. It passes through, let me call them like agents, and other people it passes through, maybe like middlemen and stuff. But in this, for this case, we're going to look at the bank. So the the government of Uganda can pass through Bank of Uganda, which also passes through the commercial banks and other institutions, so that people can come and invest money. And as a way of borrowing, the government is borrowing money from these people, so that at the end, you're able to receive, you're able to earn an interest on whatever money you've invested, and the government gives back to you the interest you've accumulated over time. So these securities are basically broken down into both the short-term and the long-term investments. For the short-term, they are the Treasury bills, and we shall look at them in detail as we go down. Then for the long-term, they're known as the Treasury bonds. So as we move on, one of the reasons as to why we should invest in these securities is that they offer a competitive rate of return compared to other interest-bearing products. This is very obvious. So once you invest in any of these securities, you are sure that you're going to get back your interest, because the government can never rob off anyone. Like, since you're lending to the government, obviously it's not like there's going to be a change of government anytime, or even if there's a change of government, you'll still be assured of getting back you should be able to get back your interest after the period you've invested in. Then they're risk-free, so you're guaranteed of your returns. They're tradable, which means that in case you're running maybe a long-term security like a T-bond for 5 years, and maybe after 2 years you get an emergency, or you're stuck and you need some cash, and this is the other option that you have that can generate for you some money. You can bring it back and you break the security, which means you bring it back to the bank, and then you're able to sell it back to the bank. The bank buys it from you while you sell it back to us, and you get your money within 24 hours. Then they can also be used as collateral in case you have a loan with in case you want to take a loan with the bank. You can offer the security that you have running as collateral. So the other bit is like the investment, who can invest in the securities, and the minimum amount. So first of all, the minimum amount of investment is 100,000 Uganda shillings for both the short term and the long term. Then also, these securities are strictly held in local currency, that is UGX. So commercial banks and insurance companies, private companies, SACCOs, pension funds, and individuals also can trade in these securities. The requirements are very simple. You have to be you have to have an account with Stanbic Bank, a passport photograph, and then you, in case it's your first time to carry out this investment, you're supposed to fill out a form known as the Central Securities Depository Form, CSD, which sits with Bank of Uganda. So that becomes your unique identifier with Bank of Uganda. You open it only once at the time of investment. So once you open the CSD, next time as you want to carry out more investments, you just have to sign another form known as the purchase form, which gives us debit authority to debit your account. Without signing that purchase form, we can never debit your account for any investment, because it will be like you haven't given us permission to touch your account. So that's the only evidence you can also show that I didn't sign my purchase form, so why did this money get off my account? Then for the charges, the Treasury bills, they attract 20% withholding tax on the interest, and then it also goes for the Treasury bonds, which are below 10 years. It's 20% withholding tax on interest, and then 10% withholding tax for securities for the bonds that are above 10 years. Then on the next slide, we just wanted to talk more about the Treasury bill. So as I said earlier, the Treasury bill, it's basically the short term, and it comes in tenors of 91 days, that's 3 months, 182 days, 6 months, and 364 days, that's 1 year. They are issued at zero coupon rates, meaning there is no interest paid during the life cycle of the bill. For example, if you invest in a bill of 91 days, you don't expect to have an interest paid like maybe after some days before the 91 days. There's no interest that will be paid to you. The interest will be paid to you at the end of the 91 days. And that interest is subject to 20% withholding tax. So a simple calculation of a Treasury bill is so just to mention that the rates here are not the current rates on the market. The rates keep on changing, but this is just an assumption, and just to try and give you a picture of what it looks like. But we are able to share the current rates. In case anyone is interested, you can always reach out to us. We'll be able to share plus the computation as well. So this customer was investing in this customer was investing in a Treasury bill of 10 million for 1 year. Then, so if you look at this computation, the cost, let me just use the figures to explain. The 10 million, 13,643 shillings, it's what is going to go off. It's what is the amount that goes off the customer's account. Then the face value, it is what the customer, the 11,100,000, it's what the customer gets at the end. But the difference, so the third figure relates to the difference between the face value and the cost, which gives us the third figure. But remember, I mentioned that for the treasury bills, the interest is subject to 20%. So 20% of the third figure, we are able to get the tax. So if you just do a simple calculation, you're able to come to arrive at the interest after tax, which is what you get. It's the interest that you're going to get at the end of the maturity. So I've given an example that this was a bill of 1 year. So after 1 year, you're able to walk away with an interest of 869,086 Uganda shillings. So there's also another calculation, which basically relates to the first one, just that the amount has changed. And if you can see, the more the money, the better the yield at the end, because this person had 10 million, and then this is the interest they get after that tenure that they're holding the bill for, compared to this other customer who has 350 million. And then as you can see, the interest after that tenure that they're holding the treasury bill, it has increased. It's now 30,702,243. Not to discourage anyone who wants to invest, but whatever money you want to invest at the beginning, it's acceptable. It's acceptable because at the end of the day, what matters is you've put your money somewhere where it's going to earn for you an interest at the end of the day, other than just being there idle and it's not generating anything at the end of the day. So now we go to the long-term investments, which are known as the treasury bonds. So these ones are issued in tenors of 2 years, 3 years, 5 years, 10 years, 15 years, and even up to 20 years. So as I shared earlier, I had mentioned that the bonds below 10 years attract 20% on withholding tax on the interest, and then the ones of 10 years to 20 years, those ones attract 10% withholding tax on the interest. And so the difference here is that the bonds have periodic payments called coupons, which are paid twice a year, every after 182 days, meaning that every after 6 months, you'll be entitled to a coupon payment. So in my opinion, this is actually a better deal compared to the treasury bill, because for the treasury bond, every 6 months you're getting a coupon payment. So 2 options: you either reinvest that coupon you received, or you can actually use it for other things. Maybe you can plan that in 6 months, I'm going to have this amount hitting my account. I can use it for other things. Alternatively, you can reinvest it so that at the end of the maturity, maybe you've invested for 2 years, a 2-year bond, and at the end of the maturity, after you've been reinvesting these coupons, the yield, what you get at the end is even bigger and better than what you were supposed to get ideally. So I wanted to also go through a bond calculation. So this client invested in a 10-year bond with a coupon of 14.25 and a yield to maturity of 14.7. Also to mention that the bond comes with the two coupon. It comes with 2 coupons. There's a coupon rate, which is constant. It's the rate from the time the bond is issued from Bank of Uganda. It has a coupon rate that is constant. It's the second rate, which is interest of 14.7. It's the yield to maturity. That one changes. It keeps on changing due to the conditions in the market. So you always have to know that there's a difference between the coupon and the yield to maturity. So this customer was investing in a, please hold on. Sorry. Yes. Okay, we're back. Sorry about that. So this customer was investing in a bond, a 10-year bond worth 10 million. with a coupon rate of 14.25% and the yield to maturity at 14.7%. So as you can see, for where my cursor is, this customer will expect their first coupon payment on 3rd September 2020. So in the first figure, the first column here, the 712,500 is as a result of the computation of the coupon rate and the nominal, which is 10 million, to come out to derive to this amount, the 712,500. And then remember, I said the bonds that are above 10 years, they attract 10% withholding tax. So when you get 10% and then 10% of this first figure, you're able to get you're able to get the 71,250. And then when you subtract it from from this 712,500, you're able to get, this is what actually hits your account. So the day you get the coupon on 3rd September, you expect a debit of 712,500, then a credit of 71,250. Then finally, what you take away, your take home will be 641,250 Uganda shillings. Also to note that investing in treasury bills and bonds is the best option right now, especially in these unpredictable times that we're in, with the COVID and all its effects, and then the lockdowns and businesses being closed. So basically people are just struggling to make ends meet business-wise. So it will be better for a person to take up this option so that you know that whatever happens, at least your money is safe somewhere and it's just not lying idle, but it's actually generating some good returns for you at the end of the day. I would like to pause and take some questions or ask my colleague in case he has any addition. Iggy, over to you.
Thank you, Martha, for joining in. I don't know if your colleague has some questions before we can start. If your colleague has additions before we can start with the questions.
Ignatius, do you have any additions?
All right, so I'll take on the questions for now, and then we'll get back to Ignatius if possible. So we have.
Hello.
Yes, please.
Hello. Darius,
Yes.
can you hear me?
Yes, I can hear you. Thank you.
All right, thanks. I'm now back. I dropped off. I think there was an issue, but I want to thank Martha for holding forth and taking the team through the investments in treasury bills and bonds. I've seen quite a number of questions in the chat that we'll have to respond to, which is very good, and it means everyone was following. So I just wanted to add something in such instruments is the fact that always looks out for the most safest investment option. So when you choose to invest in treasury bills and bonds, it is one of those safest investment options because you're investing with government. Number two is that it is an investment which you don't need to monitor, unlike investing in a bar or a shop where you have to be, where you have to always see how things are going. The moment you invest in a treasury bill or a bond, you can rest and only expect to earn in the intervals the half-yearly payments if it is a bond. So it is one good investment option where I would like each of the members on the call to really learn as much as possible and ask as much as possible to understand so that you can choose to invest. The other good thing is that, and that's what Martha touched, is the amount. Many times people tend to think that to invest in such instruments, you need billions, you need hundreds of millions, which is not the case. You need as low as 100,000 Uganda shillings to invest in a treasury bill or a treasury bond. We can start small and keep building such portfolios. That is the encouragement that I want to give everyone on the call to start testing it and having such an investment. The other for me is that such investments are near cash. So today, or tomorrow, if you needed cash liquidity to do something, these are instruments you can easily liquidate. You just engage your relationship manager in your bank. It does not necessarily mean that it has to be Stanbic Bank, but you engage your relationship manager, and if that institution has sufficient liquidity and they are able to liquidate the instrument, then you get your money instantly. At least I can guarantee everyone that with the balance sheet that we have at Stanbic, you won't have any issues of having your instrument liquidated as and when you need cash. So it is a near cash investment, and it's not like land or any other you may invest in where you can't liquidate. For me, which is also very critical, is that you're paid interest. That interest you're paid in the 6 months, if it is a bond, you can reinvest it. So you can choose to reinvest it and make sure that that interest keeps earning interest. The element of compounding. So you stand to benefit more when you keep investing every other coin that is made out of the principal amount that you invest initially. So it's something that I thought everyone should also pick so that it helps to build your wealth journey. That's why I started with asking about wealth, because investing means you want to build your wealth journey. You want to build your wealth portfolio and protecting your future, especially when you get into retirement. So there's such good information. You may know that when you're choosing the market orange, it's no longer, so it's about you being in the market all the time and starting small. You don't need to say, I want to first sell, build to 50 million to start such an investment. The other for me is that it is you to take the decision. And it has to be, you have to follow your instincts. So you have to get your decision as an individual. You don't blame anyone that, I went into such investments because Matthias or the other person is also doing it. So you have got to ask as much as possible. We have sufficient time to respond to most of them. For now, Darius and Martha to quickly look.
All right, thank you very much, Matthias. Thank you very much, Martha, for sharing with us. We have some few questions with us here, and then I'll read them out and you can respond. I'll read them out in bits, and then Martha and Matthias can respond. Okay, so let me start with this. Mukisa Tendo is asking, if I invest in a 5-year treasury bond, when do the payments begin to get into my account? Then, can I keep increasing the amount of my investment? For instance, if I initially lend 50 million to government for a 5-year bond and would like to increase it to 70 million in the 3rd year, is it allowed? And then, do the same terms apply for United States dollars? And then Philip Mwanka is asking, what are the related bank costs? Then Rose is asking, do you also walk away with the principal amount? I think some of the questions are similar, so I'll read a bit more. Amanya is asking, between treasury bills and investment units, which one has a good return on investment? Do bonds attract tax? Do I have to have an account in Stanbic alone or any other bank? And then lastly, if I can allow Martha to respond, as a newbie about bonds, how do I start to invest in them? What do I have to know? I think she did allude to some of those. But over to you, Martha, to respond to some of those questions. And then we'll come back in the next round with the other set of questions.
Okay, thank you, Darius. So I will first respond to the last one. As a new person to this investment thing, what do you need to know? So basically, you just have to have a Stanbic, you have to be a Stanbic bank account holder. That cause reason why you have to be a Stanbic bank account holder is as a Stanbic, in case you've chosen as a Stanbic to help you with the investment, we have to debit on your Stanbic bank account. That's the purpose why you have to have an account with us. Then a passport photograph, then a fully filled in CSD form, which we forward to you on mail. And then in case you're ready, we're able to share with you cash flows on your personal email. We take you through what exactly you'll be getting, the interest you'll be getting at the end of the period. And in case you're comfortable with it, that's when we can now go on and forward you the purchase form, which you sign. And after signing, as I said, that gives us debit authority to debit your account. So after that, it's all on our part. We're the ones that liaise with Bank of Uganda while you're seated and resting. For us, we do the other work for you. So also to note, we have to provide for you a holding statement so that you know what exactly you're holding with Bank of Uganda. I don't know if that answers that person who asked that question. Then someone asked, do you walk away with the principal amount? Yes, in case you walk away with the principal amount at the end of maturity, plus the interest. Let me say if it's a bond, if I said for the bond, you be entitled to these interest payments every 6 months. So if your maturity maybe is on August 3rd, you invested like 50 million. So you get your principal plus the last interest that you are supposed to get. So you get your principal and the last interest payment that you've been getting over these 6 months. So just to answer that question, you walk out with also your principal as well. Then do the bonds also attract tax? Yes, the bonds attract tax, 20% withholding tax on the interest, and 20% for the bonds below 10 years and also the treasury bills, 10% for the bonds 10 years up to 20 years. Then, so another question came in, if the person can keep on increasing the amount. So if the person has invested, if the person invests in 50 million for a 5-year bond, and they would like to increase it to 70 million in the 3rd year. So unfortunately for the bond, it's more like a contract. So if you're going to invest in a 5-year bond, it's done after you've invested in it, it's done, and then it goes away. In case you want to increase, it's not possible. You just have to open another bond. So maybe if you've opened a 5-year, you can also as well go for a longer term with a low interest of maybe 10%. So you can invest in a 5-year, and then you can also invest in a 10-year, just to widen your spread. But to answer that question, you're not able to top up on an already existing bond that is running. Then so if, and another question, if you're to invest in a 5-year T-bond, when do the coupon payments begin to get to my account? Just to add on, it's in case someone expresses the need to invest, we reach out to you and share the cash flows on your email so that you're able to have a discussion with you individually on if you're comfortable with what we are showing you, with what we're sharing with you, so that you also know that it's not just that you give us the money to invest on your behalf, but you also know what exactly you're going to get. So it's more of like, we have to include you in this whole process. So in case you want to know what you really want to, you can always reach out to us and we calculate for you, because and we also have to consider the rates within the market. These rates are not constant, that for 6 months it will be the rates, they keep on changing. So the rates, if you called up and you wanted me to show you maybe for 5-year bond pricing today, it won't be the same rate, even if you come maybe 7 days later. So we also have to put that into consideration. Thank you.
All right, thank you, Martha. I'll move on to the next set of questions. So Rose is asking, what is the purpose of first coupon and interest coupon in regards to the investment? What is the significance of the two? And then, okay, Charles is saying was affected by a network. We'll be sure to share the recording of the session later on. And I know Martha and Matthias will also leave their contacts back. And then Wise Vs J is asking, what is the difference between coupon rate and interest rate? And then, did you say interest from bonds hits my account every 6 months? And then, what is the minimum to invest? I think she already responded, 100,000. And then Michael is asking, thanks, Martha, for the presentation. I've understood everything. In my case, filling the application. Must it be online or one comes down to the office? And then, okay. And then, how safe is it to fix my money than investing in these securities? Can one open a CSD account directly with Bank of Uganda? And then the last set of questions in this segment is, if I invest in a 10-year bond, when do the payments begin to get in? If I get stuck after 3 years and need to pull out my funds, is there a charge for this? Then are we allowed to keep increasing our investment? I think she responded to that. And then I think, Martha, you can respond to those for now.
Okay, thank you, Darius. So first of all, opening the CSD account, as I said, we liaise with Bank of Uganda. So in case someone wants to invest with us, in case someone wants to invest with us, the first thing we have to do is to submit your details to Bank of Uganda we are like the middleman between the customer and Bank of Uganda. Yes, some customers can come and say, I just want to go straight to Bank of Uganda, while others want to deal with us as Stanbic. Just to mention, the customers who always want to deal directly with Bank of Uganda, those ones deal at the primary market. So for us, as for the CSD account opening, we actually do it from our side. And for us as the bank, as Stanbic Bank, we deal at secondary market. So there's also some difference between dealing at the primary market and dealing at the secondary market. One big difference is that at primary market, in case like there's an auction, a below bond auction, you don't even know what the rate is. So you enter into the auction blindly, and whatever rate comes out after the auction is what you get. So you are going to deal straight with Bank of Uganda, or even if the rate is really low, you can't back out. You just invest at a low rate. Compared to us at the secondary market, you have a chance to bargain with us on the rates, and we always have our rates readily available throughout the year. So for the question of the CSD form, you can always open it up from our side. And then someone mentioned, like, is the process online? We can always send you the forms on your email, or in case you're more comfortable, you can always walk to our branches. They can always give you the forms to fill in. before the lockdown, you could actually come to Crested Towers, fourth floor, that's where the Treasury unit is. We could give them to you, but now that the lockdown happened, we've been sharing these forms with our clients on their emails, just to like reduce on the risk of the COVID and everything. We wouldn't want people to be over congested in the branches. We thought it was wise enough to share such information of the forms, the editable forms. So you just send you fill in and send back to us on our personal emails. Then the question about the
Martha.
interest. Yes, please.
Yes, maybe I can support you with some of the other questions. Thank you for that. So maybe just to speak mainly to the difference between the coupon and the yield to maturity rate. So just to mention, support everyone. So a bond has two rates, but those two rates will work hand in hand with each other. So coupon rate is a constant rate. It's like an identity of a bond when it's being issued for the first time, because these securities, whenever a bond is issued, a treasury bill, for example, if it's today in August, they issue a bill for 1 year, that bill is going to run until next year at the same time until it matures. So if you come 2 months down the road and you're looking for that bill, to be remaining with 10 months to maturity. So same thing, the bonds, they can issue bonds for the first time today, and they will have coupon rates. That coupon rate never changes until the life of the bond has matured. What changes is the yield to maturity. So yield to maturity is like a market value of a bond, in that it will entirely be determined by supply and demand. So for example, those two will speak to what we call the face value and the cost of a bond. So you find that there are some bonds that are called premium bonds, in that you find the government is paying you a higher rate and the market value is lower than that coupon rate. So you find maybe we have a 20-year bond, for example, right now that is running at 17.5%, and it has a yield to maturity of like 15 or 14%. So that's a premium bond. The government is paying you a higher rate than the market value. So you find you're purchasing it more, but that means they're paying you much more interest every year, which is divided into two. So yes, every bond, so for example, if I'm paying you 17%, what that means is that they will divide that by two, in that every 6 months you'll be getting 8.5% of the investment, what you invested, in other words. So bonds are automatically given payouts every 6 months. And those payouts are structured on specific dates. Even though you come today and the bond is paying next week, you receive a coupon at that time. So it depends on also when you purchase a bond, because these bonds keep on running across the life. So someone else asked, what's the penalty if at all you invest in a 10-year bond and you want to move out? So there's no penalty. The only thing is that if you invest in a 10-year bond, even after 1 year, you can come and you say, I want to remove my money from the investment. That time you sell it at the selling rate. And with that, still you benefit much more than even someone who has invested in, for example, I would say a treasury bill, because you get a higher rate essentially, and then you sell it off after a year, which will get a net that is way higher than you getting it anywhere else. Maybe something else to note is that these are more or less like, I would not call them fixed deposits. These are securities. So you are not mandated to always hold these securities until the end of the maturity. In that if you invest for 1 year and you come 7 months down the road, maybe Sison has invested for 1 year, 7 months down the road, they have got an issue and they want back their money, you can sell it off and we'll give you the interest for the 7 months that you held the security for, which is quite a good thing. So they are that flexible, they are tradable. So I don't know if maybe Martha can take on any other questions, but I'll also be available for all the others.
Thank you, Ignatius. Thanks, Martha, for responding to all these questions that we've been having so far. So I'll move on to the next set of questions, which should be the last for today. I'm seeing many people have more questions. Maybe with the permission of Matthias, Ignatius, and Martha, we can arrange and also increase our Zoom capacity so that we can have more people. So we have someone asking, Matthias, is timely liquidation guaranteed? You indicated that as Stanbic that could easily buy, but if a particular bank can't, how does one liquidate? Do these instruments have provisions or options that meet requirements of Islamic banking? And then, so the rates displayed on the auction timetable are not fixed. I think she responded to that. Can the treasury bonds be used as a security for loan? I'm very sure they will respond to that. Bills or bonds, which way? So you can respond to those as I check if I've missed out any. So we'll have one more set of questions. Thank you.
Yes, so maybe to speak to that, these bills and bonds can be used as security as well. As long as you have a security or bond running, you can borrow against it because it acts as collateral in the bank, and they can loan up to 70 to 80% depending on your credit score. So yes, you can use them as security. Number two is that if you want to liquidate, so the market is quite liquid. If you want to liquidate and you're holding security and you want your money back, it takes the same day. It's not like you have to look for someone else to buy your security because these securities are bought by the primary dealers, which are banks. So in case you have the security running and you come maybe today and you want to liquidate it, you liquidate and get your money at the prevailing selling rate, which is a good thing as well. It gives that liquidity in the market. And maybe if someone asked about Islamic banking, we don't have that incorporated yet, but the whole fundamental, the whole aim of all these securities that you as an investor are looking for something to earn on your money, you're diversifying maybe your portfolio. So either way, you're looking to earn an interest on your money. So that's a major purpose. So as long as you're looking for something to earn your money on that is 100% risk-free, then it's something you can look into. So someone asked whether you can go for bills and bonds. That's now something that we discuss and we advise accordingly as advisors, because it depends on you as an investor. Are you looking to do short? We can also advise you on how you can diversify your earnings, so cash flow every month being paid out to you as well, and what you require, and then you can inform them. But either way, what you need to know is that the longer the investment period, the more the interest. At least we've seen that. So if you compare the 20-year bond that earns this, look at the 1-year treasury bill that has been trending between 9 to 13% highest it has touched this year. So you can see that definitely the longer the period, the more the interest that you'll earn. So we'll advise you accordingly, depending on your need, and we'll provide that advice as part of our work as well. I don't know if there was any other question that I missed.
Yes, there was another question asking you to elaborate on the benefits versus fixed deposits. And then I saw also another question asking you to elaborate on the initial deductions, if there are any, and any extra costs other than withholding tax. And then,
just maybe.
Yes.
Yes, maybe just to answer those two. So fixed deposit is a different asset class. Government securities is also a different asset class. They all return the same thing. They all earn you an interest at the end of a fixed deposit. It goes up to 1.5. So that most banks will go up to a year. If you want to fix your money in a fixed deposit, to go up to a year. And with fixed deposit, you're fixing with the institution. That's where you're putting the money. So the difference comes in that most of these institutions are fixing. When a client is investing, they're fixing with an institution. And most of these institutions, the banks like us, the fixed deposit rates are usually benchmarked off the central banking rate. So now that we've seen that the central banking rate is at 6.5, the all-time lowest rate that it has been, you find that the fixed deposit rate for a year is trending between the same range, between 6.5 to maybe 7 or 8% maximum. But this varies with the different banks because different banks have different needs. You find a tiny bank probably has a higher rate slightly of a fixed deposit because they're looking for more liquidity. But that comes with the risk as well. If anything goes wrong in that bank, and that means you'll take on that risk. So when you're doing a fixed deposit, the risk sits with the institution. When you're doing the government securities, it's only sovereignty risk, which is more or less like 0.00%. That's why they're called risk-free investments. You're guaranteed of getting back your money. Because by all means, the economy has to run. Bank of Uganda has never defaulted. They'll pay you back your money anytime. So if you compare like the 1-year Treasury bill and the 1-year fixed deposit rate, yes, essentially, definitely what will earn you much more is the Treasury bill. The advantage that comes maybe with fixed deposits, that there's some flexibility with the fixed deposit. If you want to earn your interest every month, that can be done, which is where some people might want to do that. But if you're looking for maybe the Treasury bonds, they pay you twice in a year, which is also something that can create cash flows for you. So the advantage with all that is that if you compound, you earn much more interest above the face value that we provide you, in that you earn much more interest at the end of the day. Yes, I think that's majorly it. I don't know if there's maybe any other question. Yes, about the deductions, there's no deduction. The only deduction that is there is withholding tax, which is only charged on the interest that you earn, strictly on the interest that you earn. There's no any other charge, and you should never be cheated by any other person as long as you're dealing in government securities. There's no any other charge because we are mandated by Bank of Uganda. It's our regulator to do that. So it's like our job to do so. So essentially, there's no any other charge. That's the only charge that is there.
All right, thank you very much, Ignatius. I think someone was asking you to explain a little bit more about what you mean by saying that for bonds or bills above 200 million, one can get a competitive interest rate.
So maybe the context might not have been got properly. So anything that is above 200 million, they are called competitive. It's called competitive bidding. You getting a competitive rate, essentially, it doesn't matter how much money you have. What matters is the period you're looking to invest in. As long as you have 100,000 and above, if you're looking to invest in a 1-year Treasury bill, you'll get that amount of money. The only difference is that with that amount of money above 200 million, essentially you can't go directly to Bank of Uganda in the primary market like Martha had shared. The Bank of Uganda put reforms in that anyone who has that money that is above that, you have to go in the secondary markets and obtain that security, because they're trying to make sure that they can, first of all, reach out to a larger crowd, but as well make sure that price is established by supply and demand. The more people invest in these securities, the more the prices for the government, the things they did, and these reforms were made last year in September, so that they took effect then. So, and what I want to make clear is that it's not about how much money you have, it's more about the period you're looking to invest. And an example is that if I have 100,000 and I'm investing for a year and I'm getting 10%, that is the rate of a Treasury bill. That means I'll get 10,000 in interest. If the same person comes with 100 million, you'll get 10 million in interest. If you come with 1 billion, that means you're getting 100 million in interest, net interest. So essentially, it's not how much really you have, it's about the period you're looking to invest, and that's where you get the advantage. But what I can show is that these are the securities that give you the highest return on the market if you're looking for an investment that is 100% risk-free. There's no any other instrument that will give you a higher interest than the government securities within the market. And it gives you the flexibility and the advantage that you're not mandated to hold these securities until the end. You can buy and sell them anytime, and we can also advise you when to sell the security, at what time, when it's a good time to sell it so that you even make much more money. We also do that. So essentially, it gives you those opportunities. And the fact that you can even borrow against it, it's also something that can help you when you're trying to really invest. But as long as you have a need, we'll look at the need and we'll advise you according to your need. We'll be able to advise you accordingly, then you can make an informed decision.
Fantastic. Thank you very much, Ignatius. This evening about investing in government securities. Friends that joined the call, thank you very much for joining. I do hope that you learned a great deal, and do hope that you're surely going to start your journey towards investing in government securities. Ignatius and Martha and Matthias, you can kindly post your contacts in the chat so that people can be able to reach out to you in case they need to get started on their journey. Initially, at the start, we lost some bit of the presentation from Matthias because of network. I will be in touch with him to see if we can host him back again and his team so that we can engage more. Please don't feel sad about it. I know he's kind enough. Most likely he will agree. And also I know that today, because we had not anticipated the much attendance, we had downgraded our account, and unfortunately we hit the ceiling. So that means that more people lost out. For future sessions, we are going to maintain more participants to be allowed on the platform so that no one misses out. Matthias, I'm going to be giving you an opportunity to give us your parting shots, but I would like to allow Imran an opportunity to ask a question because I see his hand is up. Imran, please unmute and ask your question.
Thank you, and I'll be Sinarpi. I posed the question in the snapshot about Islamic banking, and I didn't get a response. Can I get a response to that question, please?
All right, thank you, Imran. Ignatius, you want to come again on that?
Yes, Imran, we as saying, essentially it doesn't factor in Islamic banking, and majorly why? Because this is definitely strictly an investment product. If you're looking to invest and you're looking to earn an interest on your investment, that's a major purpose for all.
All right, thank you very much.
That is not yes.
Please go on, Ignatius. I had lost you, so I thought you had finished. Please go on.
No. I think that's majorly it. I was just trying to just answer that. It doesn't factor in Islamic banking as yet, as the major aim of it is just really to make sure that you earn an interest on your investment.
Great, thank you. I thought we had finished with the questions. I see John's hand up. John is the last, please. I won't be taking on another question after John. Yes, John.
Thank you. My question is that, what if I I buy a bond, like a 10-year bond from a bank, and for whatever reason that bank closes down? Can I reclaim my money of investment from the Bank of Uganda? Thank you.
Ignatius, over to you.
I think we lost John Bosco, but I think his question was around if
I picked
you
it.
invest with in government securities and the bank has a problem, isn't it? If you can reclaim his money.
Yes. Yeah.
Yes. So essentially, when you're investing in these securities, and I'll just try to stress this point, you're not investing with Stanbic. You're essentially putting your money with Bank of Uganda. So you can claim your money anytime, even though the bank has closed down, the investment is there. That's why they're called government securities. If you want to invest with Stanbic as an institution, you do fixed deposits. That's the liability that is now sits with the institution. But as long as you invest in government securities, essentially you can claim your money. If at all maybe a bank has gone down or there's an issue, because they give you a holding certificate after you invested, and you can use it to claim your money, even though a bank has a problem. But essentially, yes, you have that opportunity to access your funds in case.
All right. Thank you very much, Ignatius, for responding. I hope that was clear to John. You're investing with Bank of Uganda, so you do not have to be worried. In fact, even if the government changes, you can be assured that you'll have your money back. So once again, I thank you for the presentation. I thank everyone that has been on the call throughout the journey that we started at 5 p.m. So I would like to give an opportunity to Matthias to give us closing remarks, and then I will call it an evening.
Thank you so much, Darius, for organizing this call. And we look forward to because what we're trying to build right now is our wealth journey, all of us. As long as we have the information, the knowledge, and we have the next what exactly is required for everyone to nation. And also to thank my colleagues, Martha and Ignatius, who have come through. And I would like to request the members who are still on the call and those who have not been able to join to make use of the two members in order to have their investments done. Now, I think for me, I also would like to thank the participants. They've really given us a very good engagement. And the questions I've seen, there are so many other questions there that are still in the chat. I think, Darius, your emails so that we are able to also respond to most of those other questions. I saw a question about opening an account and whether it has charges, the number of account options back to you, and then you can share with the team what exactly we have in stock for them and how can they open an account. Today, you can even open an account online. You don't need to walk into the branch to have your account opened. You just have to go onto our website and go for online account opening, and then the account is opened. In about 10 minutes, you have your account and it's active. Now, the other for me is to encourage our colleagues that these treasury bills, treasury bonds, and fixed deposits are very good investments because, like I said, it's near cash. Number two, when you choose the instruments, then you're investing with government. So there is safety of your investment. You do not need to monitor it every day or the other day. So you can go and relax and wait for your interest to be paid as and when it is due. The other for me is that as you get into retirement, as you plan to get into retirement, where you cannot multitask, run here, run there, these are good investments to go for because then you sit at home and your money is making money for you. Okay, so again, it's good to start learning and appreciating how these instruments work. The other is these investments, like any other investment, is about the return. So to choose whether to go for a bond or a bill or a fixed deposit, the first line is to see what return is there on all options. Whichever gives you a good return and it is the safest option for you to invest in, go with that. The other is when you choose to invest in fixed deposits, always look out for the institutions display their audited. I want to see how strong that institution is. A bank might give a very high interest rate on fixed deposits outside the normal market rates, simply because they are trying to fix their liquidity position or they are actually having a very leaky balance sheet. And that should be of interest to you as an investor. So look out for such information about the financial institution and be sure that your money is safe. I think for me, lastly, is to request Darius that in case there is time, please let us know so that we can come back and have another session with the members. But let's keep engaging, let's keep communicating. We would like to support you on your wealth journey going forward. Thank you so much, Darius, and I hand it over to you to close it. Thank you.
Thank you very much, Matthias. Once again, I would like to say it has been a great learning session. We've learned a lot from you. So thank you very much for sparing your time. Do not take it for granted. And to the members of our community, thank you very much for your hunger to always learn about bettering your personal finances. If you're not part of your community, you can still become part of it. I shared the link in the chat. Let's go on, let's chat, let's continue striving to make our personal finances better. And who knows, we are going to make a movement and everyone is going to be concerned about personal finances and make our economy better. For our economy to be better, it must start from our personal finances at a personal level. How are you doing? Because if you're not being better, it means you cannot spend. And if you can't spend, it means that there's an effect towards our entire economy and we cannot make a difference. So I thank you very much for joining. Once again, my name is Darius Nkwasibwe, your financial literacy trainer, and I'm always delighted to share with you this information, link you with different people that can share wonderful information about personal finances. Have a great evening and see you next Sunday.